Hey guys, thanks for popping in, take a look and see what I have to say. You are probably here because this is it's the last in a series of videos that I've been producing talking about the economy. And I'm doing this largely because there's huge concerns out there. There should be huge concerns out there about the likely trajectory of the economy, real estate, stock market, commodities, whatever, cryptocurrency, whatever. There's huge concerns out there. The only thing that's really consistent is the lack of consistency that you're hearing from the talking heads out there on CNBC and Fox Business that really are sending you in the wrong direction. 99% of them have it wrong. And I want to share it with you because it's really important for you to know what's going on. What caused that massive explosion in our economy over the last 2 years? What likely our future looks like over the next 2 to 4 years? What you can do to prepare, and actually what you can do to make a lot of money, how to create generational wealth. So this is really the end of the series talking about the economy, and the beginning of the series that's going to introduce you to ways to create extraordinary wealth. And I hope you appreciate that because I'm finding it fascinating. Here we go. Oh, that's what we want. So I call this series the bubble of everything, or the bubblicious economy that we're in. And it's for a variety of reasons, but it all starts with what's going on and how it happened. Well, the Federal Reserve, also known as the Fed, has pumped $17 trillion into our economy, which is a order of magnitude above what it was. It's 500% plus more money in the economy in circulation than there was prior to the pandemic. What that means, though, essentially, and I'll talk a little bit more about it here in a moment. M1 is the primary money supply. It's the money that we have immediate access to, whether it's CDs or our checking account, our bank account, what's in our wallet, really, what's in our safe deposit box, what's in our safe at home. It's cash. The Federal Reserve, out of deep concern for what's going on in the economy, particularly right around the time of COVID and the lockdowns here in the US, Federal Reserve, in their infinite wisdom, decided they need to stimulate the crap out of our economy. And they did so. And one way was to just inject it with trillions of dollars. This is an experiment that's never in the history of man occurred, ever. We don't know what's going to happen, but we can make some reasonable guess. And that's one of the things that we're going to do here. The other thing they did is artificially reduced interest rates to the lowest level in US history. And now with all that cash and really, really low interest rates, what they still are today, everyone's a buyer. They also entered into open market intervention to buy bonds, stocks, and toxic assets. So we're blind to a very large degree, unless you spend time looking at the Fed's balance sheet and the underlying credit quality of some of the members of things like the S&P, then we're mostly, for the most part, blind here in the US in terms of what's going on here. And that's one of the things we wanted to share. Like, let's peel back the layers, take off the blindfold, and see exactly what's happening. We're in an artificial economy, and we are in an economy of the bubble of everything. And those bubbles are starting to pop. They started popping last September, but they don't, it's not just a function of deflating. It doesn't work that way. We'll see that when we get to some of our charts. But the bubbles are popping, and a lot of people are going to just get crushed. And I don't want you to be one of those people. I want you to make reasonable guesses as to what's coming down the road, prepare for it, and then when the opportunity is ripe, and that's gonna show up here, you're going to be able to create generational wealth with the right strategies and the right actions. So artificially stimulated hyper demand led to bubbles everywhere. This likely ends really poorly. When I say hyper demand, people have been saying that there's a supply side issue here. And yes, there was some supply chain disruption as a result of, lockdowns, particularly in China. But this isn't really a supply side issue. This is a demand side issue. You took so much cash and put it in, the Fed took so much cash, put it in so many people's pockets, and then reduce interest rates to such a low degree that everybody became a buyer. Shows up really well in housing, right? Everybody became a buyer. It's not all of a sudden we didn't have enough houses. We didn't go from more than enough supply to not nearly enough supply overnight. It didn't happen that way. What we did is we changed the buying dynamics. We hyper stimulated demand. And you're not hearing that very often. You're not hearing about this money flowing into the market, but it's fundamentally what's caused these giant bubbles to erupt. So yeah, this is, as I say, on the other hand, for those prepared, we will see once in a lifetime opportunities to create generational wealth. And I'm going to give you a couple examples of that here in a moment. So let's start with what a bubble is. It's an economic cycle that is characterized by the rapid escalation of market value or perceived market value, particularly in the price of assets. This fast inflation is followed by a quick decrease in value or contraction. Now, that doesn't need to occur. Bubbles don't just pop. Stock markets will take years from bull to bottom of the bear. Same is true with real estate, and we don't see immediate popping of bubbles. Bubbles don't just go away overnight. Although for the more liquid assets, you'll find that bubbles tend to react much quicker. Bubble is typically created by a surge in asset prices that is driven by exuberant market behavior. That means the consumer of whatever we're talking about here, whether it's a home or multifamily property or a car, their exuberant behavior is just, they've got to go out, they got to buy it now. And that, again, is one of the things that causes this disruption in demand, leaving us with a lack of supply, which further exacerbates price bubbles. Yeah, at the end of the day, fundamentals don't align with the intrinsic value of the assets. That's typically what happens in the bubble. And just remember this, something to consider. The 2008 Great Financial Crisis was a horrific recession on the verge of a depression. Took us years to unwind all that. And that was a single bubble, my friends. That was single family homes. And that bubble, if you recall, was spurred by one thing. We created a massive buyer pool for those houses, artificially created more buyers than there should have been. And that was done by the liar loans. Anybody who wanted to could go out and apply for a loan and essentially finance 100%, in some cases, 102% of a property's acquisition price. And that property could have been $1 million home for somebody who was working at a restaurant or a grocery store. They didn't have the capacity. They didn't have the means by any means, but they were able to buy it anyways. And so that dramatic increase in the buyer pool led to that bubble in single family homes. We're seeing the exact same thing here. We've taken the average consumer and created much more demand than the otherwise should be because we put a lot of cash in their pockets. Do you want to see that cash? It looks a little bit like that. This as an economist and a statistician and an investor who's literally deployed hundreds of millions of dollars, this is the scariest chart I've ever seen in my history of investing or managing portfolios, either within a bank or with an investment fund. So just let's take a quick look at this. It goes back to 1960. The M1, which again is that money in supply, the primary money supply. It's the money in your pocket, it's in your bank account, it's the money you readily can access and use immediately. Going back to 1960, the number was less than $500 billion. But as our population grew and we increased the number of businesses here in the US and abroad, in fact, that M1, that money in circulation, think about it as money in circulation. It's a simple way to do it. It grew. And then we hit the great financial recession. That's this shaded area right here. And the Federal Reserve, for the first time, took dramatic action in the form of what's known as quantitative easing. And so over the course of just over 10 years, Helicopter Ben Bernanke, and he was given that handle of Helicopter Ben because they accused him of just taking money and throwing it out of a helicopter to stimulate our economy. So over the course of just over 10 years, our M1, our money in circulation, rose from $2 trillion to $4 trillion. And that was an experiment that we have never undertaken before. As you can see historically, our money supply is relatively constant. You don't see a lot of blips one way or the other. But Ben Bernanke increased it by 100% over just over a 10-year period. And he has the ability to do that as the Federal Reserve chairman. And this is where it gets scary, guys. In 2020, the beginning of 2020, as you could see, pandemic hit, we went into lockdown, and we threw in over $17 trillion. Well, initial dump was $14 trillion, but eventually we inserted over $17 trillion into our economy, which, again, this is something that we had, this $2 trillion here, this was an experiment that we had no idea how it was going to end. It ended very well, frankly. We moderate, inflation never became an issue. It remained moderate. We stimulated the economy. We got people back to work, and the consumer started buying again. And just as a point of reference, here in the United States, the vast majority of our GDP, which is our gross domestic product, it's the sum of all goods and services, is as a result of consumption. You and I going out and buying a new car, a house, going to dinner, taking a vacation. It's a little bit backwards. We're able to do that for a variety of reasons, which I won't go into great detail, but look at that. $17 trillion installed in our economy over a period of less than 24 months. And so, I mean, that right there will explain a lot, and including how we built one of the strongest economies in America, as defined by a variety of things, including the lowest unemployment, I think, on record, maybe exactly right after World War II, but we are at or close to the lowest unemployment ever. And that's in part because we also don't have great participation in employment by those who could work but are choosing not to. This is our bubble builder. This is what created all the bubbles. But adding to that, we took interest rates from 18% in 1982 all the way down to, this is, by the way, 30-year fixed rate. This is what you're borrowing against your home at, all the way down to 2.5%. And this right here, that 2.5% is not a real number. It's artificial. The Federal Reserve, again, artificially stimulated by artificially reducing the cost at which you borrow. And it's not just for homes, it's for everything else. It's apartment buildings, it's for autos, it's for virtually anything that you use debt for, that you need to use leverage, or often do use leverage to acquire. So they did this by what's known as quantitative easing. Every month for an extended period, they were buying about $30 billion worth of mortgage-backed securities. And that demand caused interest rates to be artificially suppressed. They stopped quantitative easing, and you've seen what's happened, right? Interest rates for single-family mortgages have more than doubled. And that's having a very, very adverse effect on single-family homes. But that effect will take a while to play itself out. You've dramatically limited the number of buyers in that pool of home buyers because they simply can't afford to pay. It's not twice as much because the interest rates twice went up by double, but it's a significant factor. So really, guys, I mean, if I want you to get anything out of this, and you need to get something out of this, is that the Federal Reserve artificially stimulated demand by grossly injecting, and I think criminally is going to be the right word at some point, criminally injecting $17 trillion worth of money, increase of over 500% in our M1, our money in circulation, and artificially reduced interest rates to a level that was obviously unsustainable. And part of the problem is when they stopped buying mortgage-backed securities, stopped engaging in aggressive QE, interest rates rose to their normal level, what's known as equilibrium. And that has dramatically affected many, many asset classes, including single-family homes. Again, that's going to take some time to work itself out. But it also affected commercial real estate, which is something that we're going to talk about later. So this is kind of, I'm going to show you some charts. And these charts are largely going to support my theorem that all that money and that really cheap debt that's very available has stimulated bubbles everywhere. And Bitcoin is a really good example of that. I did a conversation back here, September of 2021. Actually, I did one in May of 21 too, somewhere around here, where I talked about Bitcoin. Now, I'm not a Bitcoin expert. I'm not a cryptocurrency expert at all. I love this notion of blockchain, and I think it's definitely a powerful way in the future for a variety of reasons. But fundamentally, my issue with Bitcoin was that it costs, and again, I'm sure I'm going to get some comments on that, but it costs about $8,000 to mine a Bitcoin. All you need, and there's no barriers to entry. All you need is computer access to the internet and power. At least that's my understanding. Why was Bitcoin trading at $66,000 or 800%, more than 800% of its underlying cost? That's a margin that doesn't exist in any business. Maybe if you own a diamond mine and you've inherited it, you've got those kind of margins, but that kind of movement, that kind of volatility, that kind of price explosion doesn't exist in the world, in the real world, and it's not sustainable. And we've seen the result of that. This is where all the money was injected. Boom, stimulus. And and as that stimulus money went away, there was no robbing Peter to pay Paul. There was no greater fool stepping in here. And so prices plunged, and they plunged dramatically. I don't know where this ends up, but I could tell you my belief is that cryptocurrency is not a currency. It's a commodity. It's an investment vehicle, and it is extremely volatile. A lot of people made a lot of money on it. And that's great. I love it when that happens. But my friends, this is not a currency. It's a commodity, at least again, in my opinion. Home prices exploded. Look, again, after 2022, we're in a deeply wounded economy here over the last 2 years. It's been wounded, and there's a lot of signs that will point to that. Excuse me, but on the back of that wounded economy, house prices and other asset classes exploded simply as a result of that stimulus. Boom. Again, there wasn't a shortage in homes. There was not a shortage in housing. There was just an overabundance, hyper demand everywhere because of all that excess cash and really cheap debt. So this is going to unwind. It's going to unwind itself in a relatively nasty way. You can't have those peaks without having subsequent volleys. If you look throughout history, and here's a really good example. This is the crash of the great financial recession. And again, the primary asset class there was single family homes. So it took years from peak to trough. And it's going to be the same here with single family homes. I will tell you though, that for those of you who bought and here's the important thing, and used fixed rate debt, that could be one of the greatest assets of your life. That is super, super cheap money that we will not likely ever see again in our lifetimes. So congratulations. Don't freak out if the value of your home drops dramatically, because you're still in there with really cheap debt, and hopefully it's long-term. If you have an adjustable rate mortgage, that's a different story. So again, what asset classes were affected? Well, certainly real estate. We've talked about that. It's not just single family home, but commercial real estate also were dramatically affected, simply because there was a lot more cash out there. Cap rates had been compressing for an extended period of time. Commercial real estate is one of the best investments of all time. And we'll talk about that more later because of a variety of things, including its great protection against inflation. It is, from a tax perspective, there's no asset class that's nearly close to as favorable as commercial real estate. And I'll point this out later, but as compared to something like the S&P over the course of 120 years, it's outperformed the S&P by 700%. Commercial real estate is the way to go. And as we see opportunities to buy commercial real estate coming up, we'll talk more about that. Equities. Let's go. Equities, all-time highs, all-time high price earnings ratio. And if you look at the Wilshire 5000, which is the aggregation of all publicly traded equities compared to GDP, that ratio is the highest it's ever been. And that's what's known as the Buffett indicator. And that just was out of control. We were 3 standard deviations away from mean. And that's only happened once. And that was during the dot-com era. And that, well, you know how that ended. It ended very poorly with a lot of people being destroyed, businesses failing. Business is failing that frankly should have been business anyways. So bonds, all-time high, now crashing. They're crashing simply because when the price of the bond moves generally inverse to the yield of the bond. So when you've got a bond at 2.5%, but the market's now at 3%, the value of your bond is much, much lower. So after a 40-year bear market in bonds, it's now reversed itself. Used cars, all-time highs. Did you know that for a while their cars were up year over year, 40%? Again, there wasn't a shortage of cars. There was not a shortage of cars. There was just abundance of buyers. Everybody had cash in their hands and everybody stepped in and bought. And that's what we do here in the US. We gorge until we can't do it anymore. And we're at that point. And I think I have a slide in here talking about household wealth. Yeah, we'll get to that when we get to it. Here it is, though. All bubbles are unsustainable and will deflate eventually, and that is a guarantee. If history is any indication of what the future looks like, it's a guarantee. And so I use the dot-com bubble and the great financial crisis and single families as being the primary bubble there. How and will this all end? That's kind of the question for you. We're likely towards the beginning. We're not halfway through the cycle. We're not at the end of the cycle. We are more likely than not at the beginning of the cycle. It will literally take 3 years before all that excess liquidity has been absorbed. And it is going to be absorbed for a variety of reasons. Quantitative tightening is one way we do that. But also spending the money and moving the money abroad. We send $120 billion a month to China for their goods and services. That's going to slow, but that's one means by which we reduce the money in circulation, at least here in the US, right? So it will take years, and that means it's going to take years to find the price point equilibrium and balance. Here's the thing to know: the liquid assets will continue to move erratically. So as an example, this is August 5th, 2022. Over the course of the last week and a half, we've had a nice little bull run in equities. And I think arguably we're already out of a bear market. So I think year over year, we're down to 8%. That's not defined as a bear market. We've rallied about 10% over the last week and a half. But more often than not, during a bear market, you will see huge run-ups, huge bull runs, but I consider those bull traps. It looks like the market's reversing. You think, oh my God, well, this stock was on sale or sold for or traded for $200 a share. Now it's trading at 150. I'm in. I like the company. I'm in. Well, that would be potentially a mistake. I'm not advising you as to what to do. I'm just telling you historically what's occurred, and you can use that, hopefully stick it in your pocket and make some informed decisions going forward. So the liquid assets, which are again, equities and other forms of investments that trade quickly, single family homes or commercial real estate, it takes a long time. That trade cycle, that sales cycle is months and months. So that will move much slower at a much more predictable pattern. But liquid assets, yeah, you're going to see them move erratically, and that's just the way it works. But here's my caveat on this whole thing. Who guessed our asset prices would explode on the back of a wounded economy? And a lot of people are saying, well, it wasn't really a wounded economy. I totally disagree. We had highest unemployment for a while there, highest unemployment ever. We still, we reversed that, but a lot of that is simply because there's a lot of people who are choosing not to work. It's called the Great Resignation. For years, we were stuck in our homes. We weren't producing much. For months, we were stuck in our homes and we weren't producing much, if anything at all. And that's one of the reasons why the Fed stimulated us so grossly. But it was a wounded economy. And I did not bet that asset prices were going north. So that's my caveat there. I saw what was going, just as a point of personal reference, I saw what was going on in China. The streets were blank, right? They had really enforced the lockdown. This is early on in the pandemic. It was February of 2020. And I wrote a paper, by the way, which I will link in the bottom of this, about this is a tsunami that's going to hit us, and it's insidious, and we are not doing here in the US what we needed to do to prepare for this. And I use South Korea as a great example of exactly what to do. And I used us as an example of exactly what not to do. And we were just devastated as a country, as an economy, as the population. I think in the US, we had the largest or the highest number of deaths as a result of COVID. And that was avoidable. I mean, in my opinion, at least. Okay, so holy moly, is there good news? Oh, yes. More wealth has been created during economic downturns during times of explosive growth. And why is that? Well, because in downturns, there's a lot less people willing to invest. People are sellers when things get difficult instead of buyers. And there's a lot less competition out there. Commercial real estate has been the single best investment vehicle over the last century, beating the S&P, as I shared earlier, by 700%, 7x over the S&P. And the S&P is investment. Real estate is going on sale, and we already are seeing generational buying opportunity. Now, I've built, bought, owned a lot of single family homes, tens of millions of dollars in single family residences, and I've done very, very well. But what I've never done is buy at the top of the market. I've been at some level, but I also anticipated to go back in to early or mid 2000s, waving my hands, crying wolf, saying the sky was falling, because I saw, as a previous banker, all that risk associated with the subprime mortgages being offloaded, and in some cases not offloaded. Quick story. I don't know. I can't even give you the exact data, but it was 2006, 2007. It was before the Lehman bust, before Bear Stearns went bye-bye. I shorted, I was very short in the market. I shorted two companies, First Federal and Downey Savings and Loan. They were two regional lenders slash banks that were, instead of loading their subprime mortgages, they would keep all those mortgages on the books, and they kept them because they were producing really good yield. But what I knew empirically is that this thing was going to fall down in a horrific way, and we would all be devastated by it. Unless, of course, well, the day I put on those trades, those were big trades. You know, for me, I think it was $100,000 each trade. I sold calls when I bought puts. So I was betting directionally 2x on each one of those. That evening, Kramer came out and said, look, if you're going to, in his Mad Money presentation, if you're going to buy any stocks that are banks, small regional banks or savings and loan, these are the two I want you to buy. Bing, bing, bing. It's a bull. And he said it's because they kept all their paper. So that was the exact reason why he didn't want to own them. He didn't want them because they were carrying all the risks. They weren't offloading it like, you know, some of the larger investment houses were. Anyways, that's it. So getting back to what I was talking about, single family is not it's been a great way to create wealth over the course of the last 4 decades, particularly as interest rates have reduced. That has caused an increase in all asset prices, including, you know, equities. But it's not sustainable. Equity, those asset prices will go down, and we don't know how long it's going to take to recover. As I mentioned earlier, it took years before we saw the bottom after the great financial crisis. So I'm a big fan of commercial real estate, and here's a brilliant example of what I'm talking about. This is an asset known as AT&T Center. It's in St. Louis, Missouri. It's a 1.25 million square foot Class A minus office building. It was the last appraised in 2016, I think, and that value came in at $210 million. As you can see on your board, it recently sold for $4.1 million, which is about the average price of the homes here in Laguna Beach, or $3.28. That's not a typo. $3.28 a square foot, or 2% of its previous value. Now, I'll acknowledge this is a rare trade, but we're just at the beginning of the down cycle, guys. We're going to see a lot of other deals like this. What could you do with this office building? Well, you have to be prepared to reposition it. You have to be prepared to hold it. and that's going to cost. But whoever bought this is going to create generational wealth, at least in my opinion, if they manage it well. And that's a whole separate conversation that we'll have. I make a note here that whenever you can, and I think this is going to be more prevalent than not going forward, buy below replacement cost. That dramatically reduces your competitive set. Somebody, if you've got the cheapest building at the lowest price point and basis, then you're going to be able to undercut all of your competition as it relates to lease rates and that sort of thing. So, and again, that's a whole separate conversation. But look, that's the building. I mean, how about you just sell a floor to a family? Every floor, different family, they remodel it, create a whole giant penthouse, a giant suite, or maybe you break up a floor into 3 or 4 sections. Let somebody else build it out. I don't know. Convert the whole thing to multifamily. We still seem to have a shortage here in the US. So yeah, that really did sell, and it's traded back in May of this year. So the coming downturn is nothing, in my opinion, to be afraid of, but it is an opportunity to invest at generational lows and create, again, generational wealth. Rothschild is one of the members of the Rothschild family, probably the wealthiest family in the world. We don't know, but the estimated net worth is somewhere in the $2 trillion range. Their motto has been, buy when there's blood on the street. I am buying. Another one of their sayings is, buy when there's blood on the street, even if it's your own. So buy when others are selling, and do so only if you really want to crush it. And I want to show this to you because it's really important. These opportunities, such as that building I just pointed out, the AT&T Center, come along because nobody else, because that's an asset class that's out of favor. Nobody wants to buy it. Everybody wants to sell it. Nobody wants to buy it. That's when you need to be a buyer. So fear and uncertainty is everywhere. And now is the time to prepare. When I say prepare, I'm not saying go buy a building tomorrow. I'm just saying, prepare yourself, rally your resources, husband your resources, minimize your expenses, and start educating yourself in the world of commercial real estate. Because I'm telling you, my friends, will be no better investment over the next 5 years than commercial real estate. And I have personally managed more than $6 billion worth of real estate in good times and bad times. And I have attended to more than 10,000 investors over the course of my career. No kidding, more than 10,000 people who invested in the real estate that I controlled. And I have seen them just crush it. My job oftentimes was to prevent the loss of the real estate through negotiating or renegotiating their commercial real estate debt, or retraining the asset managers to show them how to create sustainable revenue that is growing instead of falling. But look at this chart. I'm hoping that you can see it well. This is the typical emotional cycle associated with an economic cycle. Generally here in the US, an economic cycle is around 7 to 10 years. This last bull run has been 12 or 13 years, and it's been extended dramatically by, again, all that cash that's in the marketplace. But the bull run starts with optimism, then excitement, then thrill, then euphoria. This is what this section right here is what put us at the peaks for every one of those asset classes, whether it's the stock market or crypto or single family homes. That euphoria, and combined with the ability to execute, meaning you have the capital and you have the access to debt, you're able to go out and buy. After that point in time, and each asset class will have a different point in time, generally speaking, although there's generally also a consistent emotion associated with the general populace. So you hit euphoria, that's your peak. And then we start to, I don't know, fall down the curve of emotions. Excuse me. Yeah, here's an example. You're in denial. Well, this is a temporary setback. I'm into this for the long run. Bear with me for a second. I'm into this for the long run. I'll stick around. And then fear becomes the dominant emotion. And that's when the markets continue to plunge or deteriorate. And then there's desperation and panic. And generally speaking, we end in capitulation. And that's when people are just like, let my home go to foreclosure, I'll give it back to the bank, and then despondency, depression. But this is where we have the greatest opportunity. The point of maximum financial opportunity is in this area when no one else is a buyer but you and your well-educated friends. This is where generational wealth is created. And frankly, friends, all it takes is one good deal, and you can change the course of your future generations. You could be that guy in your family that changed generations. So that's what I have to say today, guys. Oh, here, demand destruction. This is what I want to talk about a little bit. Demand destruction happens when the consumer is no longer willing or able to pay for a good or service at the prevailing price. Think of home sales today. Home sales are declining. Listing prices are being reduced, and there's a much smaller buyer, but we're not there yet in terms of capitulation. It's as much an emotional response as it is economic. We are emotional creatures, have always been, and therein lies the opportunity. This is a chart that, using different major metropolitan areas, talks about physical occupancy for office. And it's all office, whether it's the single 1,000 square foot office on the corner or the AT&T Center in St. Louis. Occupancy, and this is just 100% occupancy, and that occupancy was not actually 100%. It was probably around 94, 95%. But they're using 100% just to kind of give you some inflection points. COVID hit, went into lockdown. No one went into the office. Well, some markets did. Well, like Austin and some of these other more aggressive, those who tend to pay less attention to some of the dictates. Oops. Yeah, they didn't do what others did. Look at San Francisco Metro. I'm not going in, no way. So anyways, here's my point, that office occupancy averages about 40%. So what that means from an ownership perspective is that owners aren't going to be able to afford the debt service payments. Now, the good thing about offices, generally you have long-term leases. And so a lot of the occupancy was economic and not physical. And the distinction is, if there's a lease in place, that's economic occupancy. Even if there is a lease in place, doesn't mean you're going to have physical occupancy. So this is physical occupancy that will at some point trend towards economic occupancy. In other words, people aren't renewing their leases today. And that's true whether it's retail or office, mixed use. Those leases are not getting renewed. And if they are getting renewed, in many cases, unless it's an extraordinary building, it's for at a fraction of previous rent per square foot pricing. So this is just a really good idea, or a good example of demand destruction. Demand destruction is something that we are starting to see every day. That demand destruction happens in a variety of ways. Here it's showing up in terms of physical occupancy that will again at some point translate to economic occupancy. Office and retail are deeply troubled. Hospitality is next to fail. Again, hospitality took a huge hit, just as most other asset classes did. The two exceptions as it relates to commercial real estate are multifamily properties and industrial. They have crushed it over the course of the last 2 years, but that too will change. And that's a whole separate conversation, but that too will change. It always does in a recession. By the way, this notion of recession, it's not the recession we need to fear, because frankly, we are in one as traditionally defined, which is 2 quarters, sequential quarters that we saw negative GDP growth. And that's a whole conversation I want to have with you, because we saw negative GDP growth despite the fact that we had huge inflation. So the cost of our goods and services that we went out and bought increased by 9.1% roughly over the last 12 months. So what we went out and bought cost more, but we bought less, a lot less, obviously 10% less or somewhere in that range. So that's just the beginning, my friends. And there's still pressure by the Federal Reserve to increase rates to tamp down inflation. I will tell you this, that recessions lead to corrections in asset prices. It's not the recession itself that's the problem, particularly when you've got such great employment numbers out there. It's the corrections of asset prices that tend to be the big issue and cause us to get to that point of despondency and capitulation. That's what we need to be concerned with. But our approach going forward is that we're going to make a fortune in this downturn. It always happens. There's always somebody who makes a fortune. I've done very, very well buying distressed commercial real estate. That's where the vast majority of my net worth came from. And so I expect to do it again in a very, very robust way. It's a huge opportunity. Will you participate? If you want to participate, I have a masterclass coming up here in the next 5 days, and I will give you everything you need to know to buy your first distressed commercial real estate asset. I'm not telling you to go out and buy it now, but I am telling you to prepare. And to prepare, you need to start your educational process. And this masterclass is a really good place to start. Thanks for sticking with me. I know this was a long one. I hope I didn't ramble too much, but it's been my pleasure. And look, I'm passionate about sharing with the world what they need to do to prepare for this. And look, even if it's not your intent to buy the dip, prepare for the dip. Minimize those expenses. Look at your credit card bills, look at your bank statements and say, well, this is a monthly recurring payment. I don't need to make that. I don't need to make that $19 here. I don't even use that good a service. Things like that, which I call leakage. Minimize your leakage, cut your expenses, husband your resources, keep your assets, which is mostly cash, and access to debt intact. And educate yourself. Thanks, guys, again for showing up. It's been a pleasure.